today. Welcome to your class. We are going to cover the essential language that you will need to speak about the economy. Right? So we are going to have an amazing class. We are going to talk about the economy. Everyone is discussing this right now. It's the hottest topic. What's going on in the stock market? It's been flying. It's been a great party if you've participated in it. If you haven't, then no, this doesn't apply to you. But we had some great conversations in my business English classes, my advanced business English classes. So I talk to people in the financial industry. I have a lot of clients. I work with a lot of people and I coach them. I teach them. We have some discussions, and this is the biggest one. So I'm creating this lesson so that you can feel comfortable talking about the economy, about what's going to happen. So we're going to combine the future tenses, all future tenses, and the economy. So even if you're not interested in the economy, then you can still learn English. You can still practice the various future tenses. All right. Hi, JJ. Welcome to class. Welcome to all the members that are joining from the community. Ooh, CSA447 from Prague. Dobry večer. Dobry večer. Good evening. That's good evening in Czech, right? So good evening. Dobry večer. Welcome, everyone, to your business English class. All right. So if you don't know me, I'm David. I have podcasts. I create content. I do corporate trainings. I have a lot of corporate clients, a lot of companies that hire me to teach them the best English. But in my free time, I share that knowledge with you, with my audience. So follow me, join my community. Right? You can see me on social media. I'm on all platforms. But if you want to get the best knowledge, the best connection with me, join the WhatsApp community, exclusive content that I don't share on different platforms. You get everything in the community. You have weekly challenges where you can participate, you can share, you can talk to me. You can use English. We have a speaking club, a great community, Zoom lessons, and direct access to me. You can ask questions. You can ask for help. We have other members, very nice people in the chat that can also help you, right? So it's a very nice place, very, very nice place. And that's it, okay? So reach out. And Sonia is here. I'm doing well. Thank you for asking. I'm back in Prague. I took a few days off. I was in the forest. I was spending time with family, right? But I'm back. I'm back, so no worries. I got you covered. Right, so business English, and we're going to talk about economics. So the economy is it's what's going on in the world, in the financial world, right? So the economy, a lot of people mistake, right, or confuse the economy with economics. So the economy is the state, right, of a country in terms of the production or the consumption of goods, right? And the supply of money, right? So that's the economy, basically. Economics is the study of that. So don't worry, this is not going to be an economic course. It's an English course, but with an economic context. All right, so here we have a situation going on. This is a situation, and what is the situation that we have here? So we have an economic growth is down, so a slow or negative growth, meaning it's a contraction. But we also have inflation, right? Prices going up and unemployment is going up. What is this called in terms of the economy? What is this called? Is it called deflation, stagflation, hyperinflation, or shagflation? All right, which one is it, guys? Right, so this is a combination. So it's It's several factors, right? So typically, right, traditionally, you have inflation, but inflation goes hand in hand with economic growth. So people have jobs, there's a lot of money in the economy. So prices are going up, but it's okay because people have money, right? So it's people have the money, prices are going up, but people can handle it. This situation here is prices are still going up, but unemployment is up. People are losing their jobs. The economy is not doing so well, but prices keep going up, right? Prices continue to go up. That is called stagflation. Okay, so the correct answer is B, stagflation. Don't worry, this is for my, you don't need to remember that unless you're a business person or you're an economist or you're in the financial services sector. And I have a few students who are in the financial services sector. So if you want to improve your business English, I have a special group for you. Right, it's advanced and it's business people, and we talk about these things. We talk about technology, we talk about economics, business, entrepreneurship, and we have Zoom lessons, and it's a course. So reach out if you want to join the business English community. I got you covered, right? But you don't need to know all of this. You just need to know this. So one of the tenses, the future simple, is will plus base verb. Very, very simple. It is the future simple, right? Will plus the base verb. So prices will keep rising. So it's will plus keep. Prices will keep rising even if the economy slows down. A clear sign of stagflation. Prices will continue to go up, but the economy will slow down. That's stagflation. That's what a lot of people are worried about, right? Even though they say inflation is under control, not everyone agrees on that, right? So try to use the will plus base verb. Okay, so if you're in the chat, if you're in class, right, the community is in class, I want you guys to use this language. So JJ, stagflation means basically prices go up. It's inflation, right? It's inflation, prices are going up, but the economy is going down, basically. Okay, prices go up and the economy is going down, right? So unemployment is going up, right? It's basically the worst situation because you have the worst of both worlds, right? If you have deflation, prices are going down, right? And the economy is going down as well, right? So people are losing their jobs, but prices are going down. Right? Inflation is prices are going up, but the economy is also going up. People have jobs. So it's bad, but it's not that bad. Stagflation is the worst thing. It's no jobs, slow economy, and inflation. Right? So it's the worst combination. It's the worst combination. And some people think that's coming, right? So future tense number 2. This is be going to. Right. So be going to. It's another form of the future. Instead of the will plus verb, it's be going to. So the market is going to crash if interest rates remain high. Right. So the market is going to crash. So we have markets like the housing market, right? That's the real estate market, but we have the commercial real estate market and the residential real estate market, but we also have the stock market. I have the bond market. We have a lot of different markets, right? And this is the financial market. So we also have the traditional markets where you get your fruits and your vegetables, right? The farmer's market, but that's a different kind of market. We're talking about financial markets, right? So, yeah, the market will crash if interest rates remain high, right? Because credit is the lifeblood of the economy. And so we need low interest rates for the economy to do well. But at the same time, inflation is also an issue. So you don't want inflation to get out of control, right? But you also want to save the economy. And right now, a lot of countries, a lot of central banks are caught between a rock and a hard place, right? That's an expression where you mean there it's a lose lose. You can't do anything. You lower the interest rates, right? The economy improves. However, the inflation also comes back. And that is a danger. That's the danger of doing that. But if you don't, if interest rates remain high, then the stock market crashes. So basically, you have to choose one or the other. All right. You have to choose between inflation or crashing the markets. Hi, Ali. Welcome to class. All right. So the market is going to crash if interest rates remain high. There's a future continuous, right? So investors will be watching the Fed's next move. The Fed is the Federal Reserve. So will be plus verb ing. Okay. So investors will be watching the Fed's next move, right? Because they're not going to watch it one time. They will be watching it continuously. In the next few months, there was a Fed meeting a couple days ago, and the rates remained unchanged. No changes. The rates are still high, and so investors are just they're watching. They are watching, and they will be watching the Fed's next move, right? Because that will dictate kind of the direction. Okay, so we have already three tenses for the future: will plus base verb. I will go. Right, then I am going to go. I will be going. That's the future continuous. All right, investors will be watching. All right, they will be watching the Fed's next move. Investors will be following the markets very closely because it's getting crazy, guys. It's getting crazy. So the bubble, do you say the bubble pops? The bubble bursts? Right, the bubble cracks? Or the bubble breaks? Which one is the right one? So this, of course, we're doing, we're talking about the economy. So but you also have it in, in other contexts. Right, so the bubble, what verb do you use when you have the bubble and then you prick the bubble, right? You have a bubble and it gets bigger and bigger and bigger and bigger. And then sooner or later, there's no more bubble, right? So let's see, guys. All right, a lot of nice people. So we have, yes, welcome, Bartek. Welcome. Very nice. Ali is also there. Okay, to Barslan. Welcome, Betul. Welcome. Carla Navarrete. Welcome. All our nice friends. Right, so if you're in Vimeo right now, you can also go to Instagram and keep it open so we can get the numbers high. You can increase the numbers. You can also go on Facebook and on YouTube if you can to get the numbers. We got to get the numbers, guys. We got to get the numbers, and like that, the algorithm will be like, "Wow, look at all these students. Look at all these people watching." All right, so here. All right, guys. Very, very nice. So here, if you can, that would be a great help. In the chat, you will find the links to the YouTube channel, right? And also to the Facebook, and like that, you don't need to you can interact in the classroom, in the Vimeo classroom, but you can at least open it up, open the open it up, and just have it in the background, right? That could be a good one. That could be a good thing to do. All right, so yeah. All right. So anyway, guys. So if you go to my Facebook account, you can also do that. But don't worry if it's too complicated or if you can't do it. The most important thing is for you to learn, right? So Maria, I will be swimming in the pool in the morning. Very nice. That is the future continuous. Will plus be plus verb ing. Right? So here, what did people say? Ooh, okay, nobody got it right. Well, actually, if you voted for pops, I will give you credit. So the bubble, you can see it pops. That's okay. The bubble pops. Now we're going to use bursts right now. It's the same, right? It bursts or it pops. Those two are okay, but we will use burst. Right? So burst the bubble, pop the bubble. You don't want to say crack or break. That's something else, right? It's understandable if you do use it, but we are going to use a different one. Okay, we're going to use a different one for our lesson. So future perfect, this one gets complicated. This one's a little bit more complicated, but will have plus past participle. And so don't forget the have. So what is the future perfect? So it's an action in the future, but before another future event, right? Now I know it sounds confusing, but bear with me. Be patient. By 2030, the housing bubble will have burst, leaving many overexposed. All right, so let's break this down. Let's try to understand this tense. By 2030, so it's 2025 right now. 2030 is in 5 years. You say by 2030, right? So that's sometime before 2030, the bubble will have burst. So it's will because it's after 2025, but it's will have burst because it's before 2030. But we don't know exactly. That's why it's perfect. That's why it's a perfect tense, because you say it by 2030, the bubble will have burst. Now I know what everyone is saying. Some of my students who are very successful, the smartest people you'll ever meet. A lot of people, we know that bubbles always burst, but somehow we think this time's different, right? We just say, no, right now we have AI, we have ChatGPT. A market collapse is impossible because we have AI, we have computers, right? We figure it out. Just, growth forever. But that's not, it's never happened, first of all. Collapses always come. And we're going to talk about that later because even though you can't really predict it, you can see the signs. All right, so if you want to write a future perfect tense, go ahead. Maria says, tomorrow I will have finished swimming. I will have finished, so that sounds a little bit off. I will have finished swimming. You can say, I will have swum. Right, I will, so instead of finished, just use the verb to swim in the past participle. So swim, swam, swum. I will have swum. I will have swum by midday. That's good. That's good. Okay, so I will have swum. So that's, now you can say, I will have finished. I will have finished my swimming routine. That sounds more natural. I will have finished my swimming routine. That works, right? But it's a little wordy. Okay. So Jay said today I was about to burst. Okay, yeah, you could say that. You could say that due to some guests who have not been, so not been polite at all. Not been, right? So not, so you put been not. Make sure they're in the right order. But that's a good sentence, JJ. Okay, so I'll give you a point for that. Okay, I'll give you a point for that sentence. Good. Good. I will have finished my chores by 10 p.m. Good. It means between now and 10 p.m., you will have finished all of your house chores. That is correct. Back to the economy, right? By 2030, the housing bubble will have burst, leaving many overexposed. When you're overexposed, you have too much in the market. Right? You have too much, maybe you have too much debt, you're over leveraged. That's a different term. We'll talk about that later. Too much debt, maybe you don't have enough cash, right? You have too much money in the market, too much debt, and the same thing happens every single time. Right? So here you have the 18-year real estate cycle. 18-year real estate cycle. Right? I didn't invent it. It goes back years and years and years, and it shows that every 18 years there is a real estate market collapse. That's what it shows, right? That's what it shows. It's not me. It is, right? So in 1972 and 1989 and 2007, right, there have been real estate market collapses. The next one, if you calculate 18 years from 2007, well, that gives you 2025, 2026. It's not exactly 18 years. It's more or less, but that's the data. So sometime in, like at the end of this year, or maybe next year, we will probably see a housing market collapse according to this model. Of course, you don't know exactly, all right? You don't know exactly, but that's what the data shows, right? The data shows that every 18 years there is a big real estate market collapse, right? So let me ask you this question. Now, if you're on Instagram or YouTube or Facebook, you can write in the chat. So, how's the real estate market in your area? Is it flying? Option number one, flying means it's amazing, price is going up, right? Is it stagnating? Means it's slowing down. It's slowing down, right? Is it you know, you know, maybe, well, stagnating or slowing down is the same, or is it crashing? Okay, so let's talk about that. Three options. You choose the best one. How's the real estate market in your area? Right here, where I live in Prague, it has been flying. Right, property values are just going up like crazy, just flying. Right? Everyone's buying. Everyone, you know, everyone says, okay, you know what? I'm going to buy houses. I'm going to buy apartments. Right, and most of the world's wealth is tied up. It's tied up, meaning when something's tied up, meaning it's invested in properties. That's the biggest market in the world. There's a lot of money in stocks, of course, and in other assets. The property market is the biggest one in the world. So, of course, right, it will affect everything. Mm. Okay, yeah, sorry about that. Sorry that your internet is not working, JJ. Okay, if you want, you can go to Instagram. Maybe your experience will be better on Instagram. Okay, so yeah, most people said that the real estate market is flying. This model says that that the party is almost over. So here's another tense. This is another complex tense. It's the future perfect continuous. Will have been plus verb ing. By 2025, the real estate cycle will have been expanding for 18 years. That's advanced English. This is very, very technical, very advanced. What does it say? Right? So by 2025, or by the end of 2025, because we are in 2025 right now, but let's say by the end of 2025, the real estate cycle, remember it's a cycle every 18 years, it starts again. 18 years, and then back to square one. It starts again. By 2025, by the end of 2025, the real estate cycle will have been expanding for 18 years. Right? So since 2007, 2008, the big crash was in 2008, even though it started in 2007. I remember because I was in college, I was studying business, and we were studying this. We were like shocked. We were shocked because they thought that it would keep going up. Look, it's a perfect. We're securitizing these loans, so people are buying homes, and then we are selling these loans as investment vehicles, as securities. So banks pretty much, they loan out the money, and then they sell those loans to investors. So they thought they had figured it out. They thought that was the solution, right, to the economy, that would solve every problem, and that the housing market, would continue to grow exponentially forever. We know that that didn't happen, right? So even like in Spain, I remember in 2008, 2009, I knew some people who were buying houses in Spain for €1. €1 a house, because there was a huge real estate market crash in 2008. Do you remember that? Maria from Spain, do you remember that? Right? Do you guys remember the crash, right, in 2007, 2008? Right? And it was terrible, right? And many economists believe that, you know, it's, round two is coming up. Round two is coming up. Right? It was a catastrophe. That's right, Maria. It was a catastrophe. Now, look at the situation now. Do you see any similarities? That's a question for you. I don't have the answers. You have the answers. You have the answers. So, do you see any similarities? Yes or no? Well, we're going to keep diving deep into this idea and we will try to see if we see any similarities. Now, of course, now it's the AI bubble, right? NVIDIA, right? Now we have these tech stocks. They say, oh no, this party will never end. But we shall see, right? So by 2025, the real estate cycle will have been expanding for 18 years. And we know, according to the 18-year real estate cycle, that after about 18 years is phase one. Well, so phase one is the recovery. That's when it's after the crash. Phase two is expansion. Phase three is recession. Phase four is contraction. So what phase of the real estate cycle do you think we're in? Right? Are we in the expansion phase, the recession phase, the contraction phase, or the recovery phase? Right? So, what phase are we in right now? Ask yourself. Right? So I put the poll question there. If you're in the community, you can answer that poll. If you're not, just think about it. Right? Where are we in the cycle? Are we, in the expansion where we're going up? Are we in the recession where we're, topping out? We're starting to move down. Are we in the contraction phase where it's really going down, it's bottoming, and then there's the recovery when you start to moving up again. Okay. All right. So, all right. So, if the economy is growing and improving, what would be a definition of that? Well, that you could call it, that would be, like a growth cycle. Right? We're in the expansion phase. That would be the expansion phase. In terms of the market, we call that a bull market. All right. So, very nice. Very nice. So, by Christmas, I will have been living in Asturias for 2 years. Good. Very nice. It's the future perfect continuous. Right? Will have been plus verb ing. All right, so let's look at some sentences right here. So this is very advanced, but it's good practice. By the end of 2026, we will experience or we will have experienced an economic meltdown. What does meltdown mean? Well, it means a crash, a meltdown. Right? Caused by years of excessive borrowing, that's too much debt, inflated asset prices. Assets are homes, stocks, commodities. Those are assets. So it's inflated asset prices. That means high asset prices and unsustainable government spending, right? Meaning, a lot of government debt as well. All right. So most people said here, to answer the poll, most people said we are either in an expansion or recession. So the correct answer is we have been in the expansion phase or expansionary phase. But many people believe that a recession is just around the corner. Maybe later this year, maybe next year, we don't know. Maybe now. I don't think it's going to be now. I think we have one more leg up. One more leg up. Right? But we're definitely in the last inning, in the ninth inning of this real estate cycle or this economic cycle. Because remember, real estate dictates the general cycle because it's the biggest market in the world. The real estate market is the biggest market in the world. Therefore, it dictates all other markets. All other markets follow the real estate market. Okay, so by the end of 2026, fantastic. We will have experienced. The answer is B, an economic meltdown. Right? That's what I believe, but we will see. So by the end of 2025, the real estate cycle will have been going on for 18 years. Right? So will have been expanding, will have been going on for 18 years, which is unusually long and signals that the market may be close to its peak. That's a signal that the peak is close. Right? Sometime, we don't know exactly, but soon, in the next year, right, we will reach the peak of the cycle. All right. So next one right here. Most of the world's wealth will still be or still will be tied up in the real estate sector. This is what I was talking to you about. So, meaning most of the money is in property. That's the biggest market in the entire world. The biggest market is the property market. That's why it's so important to follow what's going on in the real estate sector. So that will still be, most of the world's wealth will still be or still will be tied up in the real estate sector, making any downturn particularly damaging to average households and pension funds. Right? So if there's a downturn, if there's a crash, that will affect a lot of people. The correct answer is A. Most of the world's wealth will still be. So it's will be, that's the future simple, and still goes between the auxiliary verb and the main verb. Will still be tied up in the real estate sector. Right? So this is the issue, right? If you have so much wealth, so much money in properties, well, if there is, if something happens to the real estate sector, well, then that will affect everything from households to the stock market, to the crypto market, to the bond market, to the commodities, to the commodity market. All markets will be affected by this, right? So next one, stocks and real estate are severely overvalued. Right? Overvalued, that means they're too expensive, right? We have the value. Now ask yourself, are or do property values reflect reality? Yes or no? You answer this question, right? Or you can just put on Instagram, you can say yes or no, right? Do property values reflect reality? Right? Meaning, like, is it normal for you, or does it seem normal, to pay off a home in 40 years? Because a lot of the mortgages now are 40-year mortgages, Remember, a few decades ago in America, most families could pay off their home in 7 years. Right? In the 1960s, 1970s, an average family, and remember back then, many families had one income. The dad worked, the mom stayed at home. With one income, the man's income, typically, families were able to buy a home and pay it off in 7 years. 7 years. Now, it takes families 30 or 40 years to pay off their home. Does that reflect reality? Does that make sense? Right? For most people, it's become normalized. It's normal. It's of course, right? Of course, it takes 30 years, 40 years, 50 years to pay off the home. But a lot of economists would not agree with that. A lot of economists say, that doesn't reflect reality. Property, property, properties or property prices, real estate prices, home prices are overvalued. Overvalued means they're too expensive. So when you're in business, so to a lot of my business English students, we got to use the right vocabulary, right? If you say, oh, it's expensive, people will understand. But that's not how investors speak. That's not how Wall Street, the city of London, right? They use a different words, different expression. They say, oh, property values or properties are overvalued. Stock prices are overvalued. Right? That's much more professional. Right? And so, most people said no. Property values don't reflect reality. Right? Stocks and real estate are extremely or severely overvalued. Right? And sooner or later, we must, come back to reality, pretty much. Sooner or later, right? We'll have to come back to reality. Another nice expression here is downward pressure. But again, this is very technical. Now, it works if you like talking about the economy, about the markets, then this is great. So downward pressure, it's like selling pressure, right? Or basically when the markets are being pushed down. So when asset prices are overvalued, and interest rates are high, that creates downward pressure. Now we haven't seen it, as you can see. Look at some of these stocks. Look at Palantir. Look at Robinhood. Look at Nvidia. I mean, Nvidia has slowed down a little bit, but look at all the Mag 7, the Magnificent 7 stocks. Out of control. They have been out of control. Just pumping, pumping, pumping. If you've got money in the stock market, you've been happy. It's been a party for you, right? And so, but sooner or later, prices will reflect reality, right? We need to wake up from this dream. All right, so let's see what people are saying in the chat. So in Spain, right, in cities such as Madrid and Barcelona, many families live beyond their means in order to appear wealthier than they actually are. Fantastic. You get 5 points for that sentence because it's a great sentence. 5 points for that sentence. That's so true, right? Everyone wants to appear rich, right? They like the attention, right? They like, this Hollywood Instagram, like, yay, look at me. I'm just swimming in cash, right? And now I don't judge, people have different values and right, but it's true that people live beyond their means, right? And a lot of it is debt, right? So a lot of it is, it's like, oh wow, nice car, right? Yacht, right? Nice clothes, this, super super lifestyle. But if it's all debt, right, then it's not free money, right? You're going to have to pay it back sooner or later, right? So that is very interesting right there. Very interesting. Let's go to the next one. We are in a classic bubble. It's a bubble, guys. Right now, some people didn't realize that. Like, oh no, it's they're too focused on all these catastrophes in the world that they don't realize we're in the end stages of a bubble, a classic bubble, textbook bubble. If you studied economics, if you know about business, this is the bubble of bubbles. Like we're living in the bubble of bubbles, the bubble to end all bubbles. That's what we're living through right now. It's crazy, right? Now, this bubble is fueled by cheap credit, low interest rates in the last few years. I mean, now they're higher, but right after 2020, it was, we had very, very low, I mean, pretty much 0%, 1%, 2% interest rates, right? So cheap credit, investor FOMO, which is fear of missing out, right? Everyone loves that acronym FOMO. So investors are experiencing FOMO, and they have been experiencing FOMO because it keeps going up. No matter what happens, no matter what the headlines say, the wars and the tariffs, and oh yes, it might go down a little bit, but it keeps pumping up. So people are just, it's massive, massive FOMO, and so all of this, right? All of this speculative buying, all this speculation, will eventually burst. Right? Sooner or later, it has to burst. Now, I'm sorry to burst your bubble, but throughout history they have. Right? So bubbles always end the same way. Right? They always end the same way: a dramatic crash that catches over-leveraged investors off guard and wipes out trillions in paper wealth. Again, super, super technical. It's modern, it's cool English, right? But it's also very advanced, right? So when a crash that catches over leveraged investors, an over leveraged investor is an investor who has taken you know taken on debt, right? So when you're leveraged, you use debt to buy securities or to buy assets. So you're leveraged. So you're over leveraged means you've borrowed too much. So an over leveraged investor is an investor who has borrowed too much money, right? And so this crash will catch them off guard, meaning they're not expecting it, right? If something catches you off guard, you didn't expect it. Why? Because it's this euphoric feeling that happens in every single bubble, where just when it's going up and going up and going up, your brain is is experiencing euphoria because you wake up in the morning and you get richer and richer and richer, and just all this wealth. Now, here's the key: is it real wealth or is it paper wealth? So paper wealth means unrealized gains, unrealized profits. So when you realize the profits, you sell your investment, and you're sitting on cash. You've got cash. You sold your stock, you sold your real estate, like you realized your profits, you realized your gains. When your gains are unrealized, that means you still got your investments and you haven't sold them yet. So what happens when there's a downturn is that a lot of investors who haven't sold, right? They haven't realized their gains. Well, then they ride the wave down, right? They ride it down and they never take profits, and many times they end up losing everything, right? So that's the tricky part, right? So all these investors are caught off guard, and then trillions in paper wealth are wiped out. Wiped out means destroyed, right? So this is what happens every single time, and it's going to happen again. Now, I don't want to be the bearer of bad news, because nobody wants to hear this. Nobody wants to say, hey, the party is coming to an end, but it will be coming to an end pretty soon. Most investors will have been over leveraged. So will have been, future perfect. They will have been over leveraged for years. Right? Borrowing, borrowing, borrowing. Right. They are over leveraged, too much debt for years, relying on cheap loans and rising markets to stay afloat, to stay alive. Stay afloat means to stay alive. And they are depending on just credit and the stock market going up, right? So this strategy works for a while until it doesn't. A nice expression here, it backfires. This strategy will eventually backfire when liquidity dries up, right? Once everyone starts selling and there are no more buyers, so what happens in the market? You have buyers and sellers, right? So markets go up when you have, more buyers. Buyers keep bidding up the price. They bid up the price and the market goes up. What happens when people start selling and there's no one there to buy? That's when you have the collapse, right? So what will happen when there are no more buyers to bid up the price? When you have more sellers than buyers, well, that's when the tide turns. The tide turns. So what happens when the tide turns? We're going to talk about that later. So government debt will have reached, another future perfect tense, government debt, which is another huge issue, will have reached historic highs. Right? Historic highs. Just look at government debt in the United States, look at government debt in Japan, look at government debt pretty much anywhere in the world. Historically, we've never seen this amount of debt and this GDP to debt ratio. We've never seen it, right? And at some point in the future, I believe it's going to be, within a year to a year and a half, but probably within a year, a reckoning will come. A reckoning means we'll come back to reality. We'll wake up from this dream, right? The tide will turn and we will realize, where we are. So a reckoning will come, right? And likely in the form of higher taxes, spending cuts, right? Or currency devaluations. Those are the choices, right? Higher taxes. Nobody likes higher taxes, right? But that's solution number one. Right? Solution number two is spending cuts. That's what Elon Musk was saying. Okay, let's cut the spending. Solution number two. Solution number three is currency devaluation. That's now it's probably going to be a combination of these, right? There's probably going to be a currency devaluation, spending cuts, and higher taxes. But can people afford higher taxes right now? Probably not. Right? So what is the solution? Right? What is the solution? Is there a solution? Let me know in the chat. Do you see a solution? Right? So, debt crisis. Look at these countries, right? Look at these countries. So, general government debt as a percentage of GDP. GDP is gross domestic product, right? Now, this is from a few years ago, right? But it shows you right now it's much worse, much worse. So, government debt crisis. So, margin call, that might be a little bit more technical, but I'll explain it. It's when a broker's demand that an investor who has borrowed money to buy securities deposit additional funds when the equity in their account drops below a minimum value, known as the maintenance margin. What does this mean in plain English? Basically, when you borrow too much money, sooner or later, when the price goes down, when the tide turns, you'll have to pay, right? You'll have to put in additional capital. Right? You'll have to, pay for, you have to, put some capital in because your right, your securities, your investments are have gone down, have gone below the maintenance margin. So it's a little bit technical. I could probably spend an hour doing explaining this concept, but we don't have time. We're almost up. So here, when the tide turns, we will see who had their pants down, as overexposed investors are forced to sell off assets to cover margin calls. What does this mean in plain English? Basically, when the crash starts, investors who borrowed too much money will have to sell their stock. They will have to sell their assets to pay for the margin call, to pay for what the broker is demanding, because the price went below the maintenance margin, right? So basically, everyone will panic sell because they borrowed too much money, they were over leveraged, they panic sell, no more buyers, and then the crash starts. So many people will be caught off guard, but analysts will have been warning about these risks for years. The signs were there for anyone willing to look. So Sonia's laughing because of the expression "their pants down." Well, yeah, it's look at investors will be caught with their pants down, right? So when the tide turns, we will see who had their pants down. It's the Wall Street expression, right? I didn't come up with it. That is a Wall Street expression. It just means, whoever had their pants down was not being responsible, financially responsible with their investments, right? They had a debt to liquidity ratio that was way too high. They borrowed too much money. They had their pants down. Now, if they have their pants down and the tide, you're swimming and the water's over here, you're fine. Nobody can see anything. But when the tide turns, when the water goes back, right? When the tide turns, we will see who had their pants down, right? And so it is. That's Wall Street language right there, guys. It's not. I didn't come up with it. I'm sharing it with you because this is the Wall Street English, right? So yeah, basically that's it, guys. That's it. I wanted to do this to go over these for my business English students. We talked about this week. Everyone's panicking. Everyone in the financial industry is panicking. But at least now you have the language to talk about it. You can comfortably talk about the economy, about what's going on in the financial world today. All right, guys, if you want to join my community, my language learning community, I share exclusive content there that's not on Instagram, that's not on Facebook, not on YouTube, not on TikTok, only for my community, right? Weekly challenges, speaking club, Zoom lessons, all of that is in the community. So let me know if you'd like to join the community. I will send you the invite link and you can learn English, Spanish, or French with me. I teach all three languages, right? I have different levels, different programs. I do corporate training. I help companies I'm training a company of 100 people, right? So I do a training for 100 people, and but I also work with people individually, and I also have content and activities and challenges for regular folk who are trying to learn English, Spanish, or French. So reach out to me. I want to work with you. I can give you the results you need, and we can have fun. We can have fun and also, attain, you know, our objectives. Okay. So, Maria, you're missing a word: over leverage. Okay, I'm going to write it down in the chat. Okay, over leverage is when you have too much debt. Okay. All right, guys. Very, very good. Have a great day. Take care. Have a great week.